Hi guys. Today we will analyze Cisco stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Cisco has been an average performer in the overall market. Also recent evolutions are not positive. The long-term trend is negative. The short-term trend was neutral, but now it seems broken. We need a confirmation though. Support levels are around $51.20 and $49.40. Next support levels are around $46 and $43.80. Resistance levels are around $52 and $54.60. Next resistance level is around $57.20. In the last month the stock has been trading between $51.50 and $56.90 range. It is currently trading near the lows of this range. The stock has an average volume of 21 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 2% per year, for last 5 years. We see that the average profit margin of the stock has been around 18% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 124% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Cisco company: bad, average, and good. First scenario. Cisco will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 1%. Future profit margin would be a low, 18%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $34. Second scenario. Cisco will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 19%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $43. Third scenario. Cisco will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 20%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $54. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.8. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Cisco, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 15. Again, I will use 3 different scenarios for Cisco company: bad, average, and good. First scenario. Cisco will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 1%. Future P/E would be a low, 14. In this case, the fair value of the stock today would be $18. Second scenario. Cisco will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 16. In this case, the fair value of the stock today would be $25. Third scenario. Cisco will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 18. In this case, the fair value of the stock today would be $33. As you can see, today the stock is overvalued, $51, even if we expect the company's high performance in future. The fundamentals are good, but the company is expected to show a small growth in revenue, 5% per year. I wish the stock would be a bit cheaper to open a long position. Keep in mind that the stock has been in a downward trend since January 2022. It can go lower before it recovers. My buy price would be $45. But, dear due diligence, you may like the stock at current levels. Company's strengths. Cisco is one of the largest information technology companies in the world. It develops, manufactures, and sells networking hardware, software, telecommunications equipment and other high-technology services and products. Cisco also specializes in specific tech markets, such as Internet of Things, domain security, data centers, video conferencing, and energy management. Both sales and adjusted profits are growing. Strength in the order book suggests that the pause in enterprise spending and by carrier customers has ended, and that demand in a digital economy will exceed pre-pandemic levels. Cisco is successfully shifting its mix away from over-reliance on hardware, and toward an integrated software, hardware, and services solution. Customers are moving faster than ever, driven by the shift to hybrid work and hybrid cloud. This requires modernized infrastructure, new security architectures, and accelerated digital transformation. Cisco's return on assets of 12% and return on equity of 30% are amongst the best returns of the industry. Its profit margin of 23% is amongst the best returns of the industry. The company maintains a strong balance sheet, with plenty of cash on hand to fund share buybacks and the dividend, 2.93% yearly. Risks. A main risk for Cisco is the possibility of a general economic downturn, and a corresponding dip in demand for networking gear, related to the COVID-19 outbreak. Cisco is wrestling with supply constraints, and will be unable to fully meet demand for the next several quarters. There are still significant constraints with semiconductors, preventing Cisco from completing manufacturing of some products. Investments in acquisitions and in intent-based networking may not be validated in the market, or may be superseded by other technologies. The company competing on many fronts in drastically changing markets. White boxes, being used by service providers and large IT groups, may also be adopted by more data center and campus customers. Cisco's revenue and margins could be severely impacted without branded hardware. Customer attrition could occur, due to viable replacements in hardware and software. Also, Cisco's recurring revenue model may not be in its customers' best interest. Cisco is expected to show a small growth in revenue. In the coming 5 years, the revenue will grow by only 5% yearly. The earnings per share is expected to grow by only 7% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.